The Rebel Capitalist Show.
Okay,
Yeah.
cool. So let's go down and just kind of take it chart by chart. I think that's
Yeah.
probably the
So
easiest thing to do.
this goes back to the surge in retail deposit story that we've seen. So
Okay,
you can
great.
see that the level of retail deposits increased, let's say, $5 trillion over the past 2 years, and that's basically all
Is
from.
that all, Joseph?
Yeah,
Jeez.
these are just retail deposits. If you look at the
Yeah.
non-retail retail
I
deposits,
can't believe we've had inflation.
Well-
That doesn't make sense.
So
Yeah.
I've actually done a little bit of work about who holds the money that's increasing, and
Okay.
there's just this amazing chart that I have, and you can on one of my actually my former post, where you see
You
the
want me to
amount
go
of
over there really quick?
yeah
Let me do that.
my
Let's do
former
that for the
post.
viewers so they can see that. So I'm going to
Yeah,
go
I mean
to.
this is exactly your point too, that about
So how do I get to?
just
Do I go to
just
forum?
no, go to home, and just
Home.
scroll down.
Okay.
Yep, scroll down. Mechanics
So
of it. Yes, this one. Continue reading. Yep. So
which chart?
just lower down a little bit. Yes, this one. You can click it, I think.
Right
You
here.
can click. Yeah, that one. So this is money held by the held by households, so not
Wow.
businesses,
Look at
not.
that.
And this is
Jeez.
checking account money. So this is not savings account. That's another graph. It's just in your checking account. And that $2 trillion
Man.
surge, that's all from pandemic transfer payments. So you think inflation, the
Whoa.
government basically printed trillions of dollars and gave it to like mom and pop, right? So
Yeah,
part
you
of
know,
that
I
was
always look at M2 or their new version of M2, and it's not as dramatic
yes.
to think that this is actual checking accounts, right?
This is study that you were talking about. Checking accounts from households, so not corporations, not the government, not financial sector entities, just households. So this comes from two things. One is the just stimulus checks, right? And the
Yeah.
other is PPP loans. So people don't talk about PPP loans, but the PPP loan program, I think it was like 800 billion, and there's another 300 billion in something related. So it basically gave 1.1 trillion dollars to small businesses. Part of it has to go to payroll, but that's just that's just off the magic money tree. So that
Yeah.
filters through to this through wages to this, and that filters and the transfer payments from the stimulus checks do as well. So this is just amazing, and you think that we have so much. Listen, people wonder why we have inflation in goods. Well, people are buying stuff because they have a lot of money because the
Yeah.
government gave them that for free.
Makes a lot of sense. Okay, let me get back to the article we were discussing. That was really dramatic. I've got to use that on my whiteboard.
I know, it's amazing, right? It's amazing.
Yeah, that's an eye opener. Okay, so now we're down at hiking earnings, and it looks like we've got a chart here.
Yeah.
JP Morgan Chase 12-month pre-tax.
So this is going back to the pre-GFC framework when a bank would match its liabilities with its assets. So in this context, for example, thinking back pre-GFC, a bank would borrow short in money markets, 3 month, 6 month money, and the rates that they paid on that money would be closely tied to the Fed funds rate. And they would, on the asset side, they would have loans that were also kind of indexed to the Fed funds rate, well, probably LIBOR,
Right.
but moves with the Fed funds rate.
Right,
So
right.
in that context, when the Fed hikes rates or reduces rates, the higher interest rate costs that a bank has to pay is offset by the higher interest revenue it gets from its loans, and that's kind of the bank's business. Like you noted before, they make a spread. They're not really there to take interest rate risk. And so back then, that chart was to show that even if rates went up 200 basis points, then JPM, I mean, it didn't really affect their earnings because they hedged their interest rate costs on their expense and their income side, so that they're just locking in that spread.
Right.
But if we go down a little bit, you'll see that business model has completely changed.
So now we're down at the next chart, the firm's US dollar sensitivities.
It's completely changed because now they don't borrow in the money markets, the rate sensitive money markets. All their funding is in rate insensitive deposits. So when rates go higher, it's just pure income to them. So they're not just taking a flat spread, they're taking like an expanding spread. So if rates were to shift up 100 basis points, their earnings increased by $6 billion. So that's very different from the past, right? That just shows that the higher the rates are, the more money they make, and they're more incentive to create credit, to make
Yeah.
loans. It doesn't actually have to be a loan to a business too. It could be buying treasuries, which is what Bank of America is doing to the tunes of hundreds of billions as well.
Yeah, so
So
let's unpack this idea because I don't think people are going to follow this unless we
okay,
really explain it. So
yeah,
let me
yeah,
try to explain it to the best of my ability and then tell me if I'm getting it correct. So what happens when a bank buys a treasury from a non-bank entity? So let's just say the average Joe and Jane is that treasury would go from the balance sheet of the average Joe to now it's an asset on the balance sheet of XYZ Bank, let's say JP Morgan. Well, how are they going to pay for that? Well, what they would do is they would transfer the bank reserves over to the average Joe's bank. Let's say that's with Wells Fargo, and they would also create another liability. Let's say that the average Joe's sold the treasuries for $1 million. So then the $1 million in bank reserves would go from JP Morgan's account to Wells Fargo, but then Wells Fargo would also create a dollar denominated liability, which would be an asset of the average Joe for the $1 million. That's how he would get paid. But those $1 million did not exist prior to JP Morgan buying that treasury. They only existed as bank reserves on the Fed's balance sheet denominated in dollars. They were not a commercial bank liability. Therefore, they could not circulate in the real economy. Do I have that correct, Joseph?
So I would focus more on the deposit side. So you're exactly right. So it, if the reserves are shift to the other bank, but I would focus more on the deposit liability stuff because side that's deposits are money that non-banks hold and use
Yeah. So, but the
freely.
bottom line is in that example, the average Joe now has $1 million that he did not have before.
Exactly,
But more
exactly,
importantly, I guess what you're saying, more importantly, we got to focus on the fact that those are an additional $1 million in dollar denominated liability that the commercial banking system has.
exactly.
Therefore, in layman speak, that's an extra $1 million circulating in the economy that was not there before. M2 money supply, or
Yes,
that chart we
yes,
just looked at, went up by $1 million.
yes. You're exactly right. So that's what happens. It
Yeah.
happens when a bank makes a loan, also when it buys a treasury, just like you described.
Yep. Yep. Okay. Got it. Got it. So now let's also go over this sentence because this sentence in and of itself, I think, is a whiteboard video. I'll read it here, and then you can walk us through. The new dynamic suggests rate hikes lead to a flatter yield curve, lower nominal rates, and potentially higher inflation through increased credit creation. And then you're saying, remember, guys, bank security purchases, and this is what we just went through, are
Exactly.
paid for through the creation of money. So we understand how that creates more dollars, that could create more inflation, but how does that create a flatter yield curve and lower nominal rates?
Because you have a so I mean you have a bank there. Well, you have banks there willing to buy, let's say, 5 to 10 year treasuries just when it goes higher because their funding cost is zero, and
Right.
for them owning treasuries is regulatory neutral. It's treated the same as reserves on their balance sheet. So
Mm,
if they have like $1 million in reserves yielding, let's say, 1%, and suddenly the 10 year treasury got to 3%, they could just swap that out and hold treasuries instead,
right, right.
and they would make more money. They would make 3% instead of 1%. Their funding costs would be still zero. So, and if they were worried about further changes in interest rate risk, they could hedge that as well. And we actually already see Bank of America doing that to the tune of hundreds of billions of dollars, just buying treasuries and mortgages. And JP Morgan has said that they would do something similar, but they're still waiting for rates to go little bit higher. So
Mm,
if you have these giant banks just waiting to buy treasuries when they go a little bit higher, that kind of puts kind of a soft cap there on how high interest rates can go. Because remember, for them, their funding costs are zero, and they have these regulatory constraints where they either have to hold treasuries or hold reserves. And so that's just an enormous amount of buying power there.
Yeah.
That kind of limits how high treasuries can go. Now, even if you think inflation is like really high, then you have these people who don't really care about where inflation is. What they care about is how it is compared to IOR and how it is compared to their funding costs, which is zero. So
Yeah.
you kind of already see this happening, and you probably see more of it as time goes on. So that kind of well, one is a ceiling, and it flattens the curve because where they're buying is probably like 5 to 10 years, whereas the short end of the curve, let's say 3 months, 1 year, 2 years, that's very sensitive to the Fed's policy rate, and that
Right.
can go up and down.
Right.
And so as the Fed hikes, so the front end, the 3 month, 2 year is going to go higher, but that 5 to 10 year, it's kind of going to stay around there where it is, or maybe go a bit higher. So that flattens the curve a bit.
Yeah, that's so Josh, that's exactly what I thought. Josh and I were sitting there noodling over that, Joseph, for about 5 minutes, and I'm like, I think he's talking about this happening, and I got it right. So I'll go ahead and
Exactly right.
give myself a pat on the back there. And for those people, I don't know if I said it at the beginning, but Joseph used to work at the Fed. He was in charge of the New York Fed's trading desk. So you're talking to the guy that actually did quantitative easing. When Jerome Powell says, "Hey, we got to do another 120 billion in QE," Joseph was the guy that would actually do it. So it's really an honor to have you on. Let's keep going down to this next chart, and this is rate hikes do not pass through to depositors.
Yeah. So okay. So Fed hikes rates, and we think that slows the economy down. It does so in many different ways. One of them, it used to be that it slows credit creation, but another way that it would do that is by raising the opportunity cost of money for everyone. So hypothetically, let's say your checking account was offering you 5% interest. Maybe you wouldn't want to spend as much money because if you left your money in your checking account, you'd earn 5%, right? So that's one channel where higher rates can dampen economic activity, slow down inflation. But if you have a banking system that is just awash with retail deposits, and just remember that chart couple charts ago,
Yeah.
we increased retail deposits by $5 trillion. So banks aren't really going to compete with banks don't have any reason to raise their checking account interest, because if you don't like it, there's nowhere for you to go, and they don't really need your deposit. They have so many. So
Yeah.
it's classic supply and demand. You increase the supply of deposits, and there's just the price of each deposit goes down, so you're not willing to pay higher interest rates. We actually saw that happen last time around too. So last time around, we had a bunch of QE deposits, and you can see in this graph, you can see the Fed funds rate hiking, but you don't the up a little bit.
Oh, right here.
Yes, you can. So this is
Okay.
the red chart. The red line is the Fed funds rate,
Okay.
and the the almost impossibly low blue line is what was offered to deposits by banks. And so
Oh yeah. So you can see it didn't even budge, even though
yeah.
Powell was
So
raising rates. Yep. Yep.
Powell's raising rates, and nothing happened. I
And
guess
and just to your earlier point, guys, just so everyone's clear, prior to the GFC, when this functioned kind of in a more normal environment, this blue line would have notched up. It would
Yeah.
always be lower, but it would
Yes.
notch up with the Fed funds rate.
Yeah.
And now that
So,
we're this system that's just flushed with reserves and IOR, where the Fed actually pays banks to leave their deposits, if you will, for lack of a better word, at the Fed, then you just see this environment where basically the retail's just getting screwed and being forced further and further out the risk curve, even if rates are increasing at the front end.
yes, you're right. I mean, so rate hikes don't. So that deposit channel, that increasing the opportunity of money increasing the opportunity cost of money channel of slowing down inflation, that's not going to work this time around, since
Yeah.
we won't see any interest rate hikes in our deposit accounts.